Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, this is James Kandasamy. Thank you for listening to this podcast. I appreciate you. I know I provide a lot of value through this podcast, and I want you to share it with your friends, with your families, and anybody else that you know that kind of benefit from listening to this kind of content. Go and share it through Facebook, through LinkedIn, through Twitter, through Instagram, or any other channels that you want to share it, because sharing is caring. Thank you. Let's go on with the show.
Hello, fellow investors. Welcome to Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guest is James Kandasamy, and he is the CEO of Achieve Investment Group. He's also an award-winning multifamily syndicator with over 2,000 doors and 160 million assets under management. And even better than that, he's a best-selling author of the book, Passive Investing in Commercial Real Estate. So thank you so much for joining, James. We've got the expert in the house today for sure.
Hey, Ken, happy to be at your show.
Yeah, thank you. So start with telling us a little bit about yourself. Help our listeners get to know you.
Well, I'm used to be electrical engineer with an MBA, and I've been doing real estate for past, 6-7 years maybe, and multifamily past 5 years. And, we own like more than 2,000 units right now, focusing a lot in Austin and San Antonio, Texas. We also vertically integrated a company, which we can go through what that means in a short while. And as you mentioned, author of best-selling book, Passive Investing in Commercial Real Estate, which was released like almost 2 years ago. And we have sold like 2,000 copies of it, probably more because 2,000 was like after 1 year. And after that, I stopped counting. and these are like all paid copies. So it's not like free book or 99 cents. This is paid copy, full price on Amazon, on Amazon.com, right? So people definitely are reading the book, paying for it, which means I do give some value, and I'm happy for that. And, happy to share any passive investing knowledge with your audience as well.
Well, very cool. Yeah, no, we'll definitely dig into all that today. So why did you start investing in real estate?
Why? It was a big aha moment when I was on a W-2 job, and when my boss came and tell me that I have to work in the company for another 16 years, and I didn't understand why, because when I came to the US, I thought I know how the cost of living here is, right? But little that I know about the cost of education, and I have like 3 kids, right? And when he told me that, and I told him I have 3 kids, and he said, "Oh, okay, so you're going to work for another 16 years." I said, "Why?" "Oh, every kid is going to be like, 100 to 200,000, right, for education, right?" "Oh, that's crazy, right? If you go for better school, it's like 300,000 and all that, right?" And it was an aha moment for me, because my education as an engineer only cost like, total like maximum $5,000 US dollars for 4 years degree. And it was a shocking moment for me. And that's the time I realized that, hey, I can't be just doing a W-2 job. I have to do some business to do, another source of income. And I was looking at different asset class like stocks or bond. I mean, I didn't look at bonds. Not many people knows about investing in bonds, stocks, and trying to do some website business. And end of the day, we settled at the real estate. I mean, we did try all that. I did try all that, and I failed. And real estate was the one that is slow and steady, and I can really control the asset using my sweat equity, right? So that attracted me a lot, and we can use a lot of business skills to find deals in real estate. And also the realization that real estate is the only asset class that you can buy below market value. Like I say, 100,000 house, if it's distressed, it drops in value, and you can buy it below the market value, right? And sometimes you go off market, you can buy a lot more below market value. And you can put mortgage on it too. Like you can put 80% or 75% mortgage on it. So somebody's giving you a loan to buy that asset, right? I mean, you don't get that in stocks, not in a true sense, not a real mortgage. and you can after you improve, you can sell it above market value as well. So which is crazy, right? I mean, there's three different area where you're buying below market value. Somebody's giving you a mortgage to buy it. At the same time, you can push it above market value. There's no other investment asset class which can give you that. For example, stock doesn't give you, right? You're buying on that value on that day, right? And you basically got no control as well. So that's the reason why I selected real estate, and it was very encouraging for me to do this asset class as my preferred way of investing.
Gotcha. And you've obviously had a ton of success, and now
Mhm.
you're giving back by educating other investors through your
Yep.
book and through other sources. So
Yes.
so
Yes.
let's dig into some of the topics in the book
Sure.
for a little bit, because a lot of the listeners out there are passive investors, or folks that are looking to invest in real estate. I mean, kind of walk us through how the book is outlined a little bit, and help us understand some of what are the main things that passive investors need to know.
Sure, absolutely. So the book is written in a very simple language. It has complex topic because I'm a very technical guy, I'm a very numbers guy, but I try not to put too much mathematical equations and to make it too much complex. So I wrote it in a very simple language. People can spend 4 to 5 hours and finish reading the whole book. Yet you're going to find a lot more details that you don't find in a lot of other avenues, right? I mean, a lot of times if you go to a conference or meetup, I mean, people are just going to talk about how do you buy apartments, right? But I want to focus on how does passive investor choose their investment. So it has like 7 chapters, with like introduction of SEC regulations, how a syndication works, how does LLC being structured. Then we go into more, how do you select your investment? What kind of what kind of consideration should you do? Right. And the biggest thing that people forget is like not all syndications are created the same,
Mm-hmm.
right? Every deal is different, but a lot of times what passive investors forget is how do they match their own objective in life to that deal, right? Sometimes people just look at the return. Oh, that's the return looks good. I like the sponsor. I like the market. I want to go and invest. But within that paradigm, there's a deal where it's a lot more heavy on cash flow. There's a lot more heavy on equity, not less on cash flow. And how do they match this different spectrum of deals to what their investment goal is? So the
Mm-hmm.
matching of that investment goal is a we go very deep into it, because I think that's very important. And a lot of passive investors just blindly throwing in money into every deal that they see, and whichever putting a lot um, whichever content they like, they're gonna invest in that deal, right?
Yeah.
Because sometimes when a lot of people find the real estate syndication, they start, wow, this is a big thing, I like it so much, I'm going to use all my $1 million in the next 3 months, right?
Sure.
They say they see 10 deals, they put 100,000 into each, but without them thinking on, hey, these deals have its own characteristics,
Mm-hmm.
right? How do I match my investment goal to this deal, right? How do I look at
Mm-hmm.
this as an investment that I'm going to be using for next 20 years, right? So how am I going to
Yeah.
achieve my financial independence? Looking at these characteristics of this deal and investing differently so that I can achieve my goal at the end, right? So there's a lot of things that we discuss in that book, which I think will be very interesting for your passive investors. And after that,
Yeah.
we go into more into indicators, right? When people talk about cash and cash, when people talk about IRR or equity multiple, what does each
Mm-hmm.
means?
Mm-hmm.
How in a very simple language, I explain a lot of I would say, complex topic um,
Sure.
into so that people can understand and grasp it, right? And I didn't want to write too long of a book, because then it doesn't serve the purpose of a passive investor, right? I mean, some people really like going into every single detail, but the primary objective of that book is to introduce people to syndication and go into concepts on how can they optimize any deals that they're going to invest to their personal
Mm-hmm.
goal. And then third is to explain the concepts on how does it work, how does the process work, how do you communicate with an operator or with a sponsor, right? When someone, when you go for a meetup, how do you introduce yourself,
Mm-hmm.
right, to the sponsor? And when you talk to a sponsor, what are the questions you're going to be asking them, right?
Yeah.
So there's a
Yeah.
lot of things that, as a passive investor, you can be a very advanced passive investor, right, by reading this kind of book, right? And that's what I put in. And also the other topic I did look at is like, what are the capital sources that they can use out
Mm-hmm.
there, right? Sometimes people say IRA, sometimes people talk about cash, right? Sometimes people talk about solo 401k, right? And then suddenly there's like yesterday I met an investor. They said, "Hey, I invested like few 100,000, but nobody talked about UBIT tax
Right.
using IRA, right? Because a lot of people just do not know about it, right? But I did talk about it in my book. Hey, you have to watch out for this UBIT tax, and
Mm-hmm.
how are you able to avoid UBIT tax? You can still use your IRA money, but how do you avoid it, right? So these are things that, I mean, as I said, passive investing, commercial real estate is the title, but the subtitle is Insider Secrets to Achieving Financial Independence, right? So yeah, we
Gotcha.
covered so many topics. Some of the things that I mentioned is some of the favorite things that people always mention to me, say that this is aha moment for them, and when you read the book, even active investors are going to be learning a lot of things too, because sometimes there are some concepts which is explained very well in the book, that even active
Yeah.
investor will be thinking that, oh, okay, I didn't even know that. So my goal has always been to make the passive investor more advanced than the active investor,
Mm-hmm.
because once you are more advanced in asking questions and looking at certain aspect of investing passively, you can make a lot more smarter decisions, right? So
Right.
end goal is create more smarter passive investors, so people don't keep asking you questions, fundamental questions, and people don't get surprised when they invest, and no one says that I didn't know about this before I invest, right? So
Mm-hmm.
that is the goal of the book.
Awesome. It sounds like a great read. I'm definitely gonna have to
Mhm.
check it out. It
Yeah,
sounds yeah, like you said, right
yeah,
up the alley for our listeners here.
yeah,
So
yeah. I mean, it's like, as I said, sold 2,000 books on a full price. Top 15 book by Jim Cramer, The Street. If you go to thestreet.com and type top 15 real estate book, my book will be number 6. So,
awesome.
so
So
yeah.
as you one topic that you mentioned was around just understanding your goals as an investor, and I love that you started there. I think that's extremely important. I mean, can
Mhm.
you go a little deeper into that of how as a passive investor do you go about defining, like
Mhm.
understanding what your needs are and what your goals should be so that
Mhm.
you can make that informed decision?
Absolutely, absolutely. That's a really good question. I would have loved to go in deep, but I don't know how deep you want to go. But so for example, let's say you are on a later part of your investment cycle, right? Your focus is a lot more like, I want lower risk, I want higher cash flow, I want more predictable income because I'm no more working, or I'm at the age of retiring, right?
Mm-hmm.
So you do not want to take a lot of risk, but you want more cash flow because you want that consistent money to be coming in, so you can retire without worrying that you're going to lose your money, or with that money not coming in, right? So you
Mm-hmm.
want to focus a lot more on a yield type of deals or core asset class, right? Where it's very, very predictable in terms of giving me that cash and cash return every month, right?
Mm-hmm.
But if you are a young guy and you have your W-2, not say young, but if you have your W-2 job, let's say if you're a doctor, right, you're going to be earning a lot of money, and you're not going to retire in the next 20, 30 years if you're a younger doctor, right? So what they want to do is they want to basically multiply their capital so that they're ready in the next 30 years when they want to ready to retire. So they want to focus more on value add and deep value add deals,
Mm-hmm.
right? So because deep value and value add doesn't pay a lot of cash flow, but there's a lot more equity multiple, right? So looking at what you are earning right now and how much is the risk, and also, as I mentioned, on a value and deep value add, the people who are focusing a lot more on capital equity appreciation or equity multiplication, they can take a lot more risk because they have their own full-time job, right? So they want
Yeah.
to target which deal is being presented, and you'll be surprised that some sponsors are very focused on core asset class, or some sponsors are very focused on value add and deep value add, right? So you want to align more towards which sponsor you are doing, right? And there's something called hybrid, right, where it comes in the middle, where you get cash flow a little bit, but later on you get normal cash flow, but you also get a lot of equity appreciation, so you can focus on that as well. So that's what I mean. Like, how can each investor, look at their risk and reward on where they are in their life, whether they get some other source of income, whereas they can take on a higher risk real estate investment and multiply that equity so that 20 to 30 years down the road, they have a lot more money and they can put it into a cash flow investment.
Right. So it sounds like the one of the main considerations is there's some investments that will put off more cash flow, may have lower overall upside, but
Uh-huh.
higher cash flow, more immediate cash flow, right? And
Correct.
it sounds like what you're saying is those pair more, which makes sense with folks that are, you know, nearing or in retirement. right? As
Correct.
it's supplemental income, right?
Mm-hmm.
Versus other deals that may have lower cash flow and have a higher ability to multiply your equity, though higher equity multiple, right? And so,
Yep.
and those fit with folks that typically, like you said, are still working, and maybe on the younger side and are still trying to grow their wealth, right? Still need to gain more wealth. Okay, so it's really important for people to understand there's a lot of different types of investments, but even just breaking it down from cash flow focused or kind of wealth or like equity multiple focused, I think is a good place to start, right? And align your goals and where you are in life with that strategy.
Absolutely. Yeah, as I said, there's a lot more sophisticated passive investors out there who are using all these strategies, but it's not very well taught to the normal investors, or especially people who are jumping into syndication, because sometimes for them everything looks the same, right? Unless we go into this kind of deep conversation, right? And there's a lot more deeper conversation which is not covered in the book, but it's covered in my video series, where we talk about like how do you look at risk adjusted return. That's a lot more advanced concept. And if you are already a normal passive investor, you can go and read that, because then it'll make more sense, but it's a lot more technical, but it's very, very powerful, because now you can earn a lot more than even active investor by becoming more advanced passive investor, right? So if you know like risk adjusted concept, and if you know like deal risk profiling, right? How do you profile a deal? Right? Because sometimes when someone show you a deal, you do not know whether this is a core deal, or is it a value add, or is it a deep value add? How do you know it? Right. But so we teach in that video series on how do you categorize them, how do you measure them, how do you measure whether this deal is more of a cash flow deal or more heavy towards back end, by using calculation, right? So, but that's a little bit more advanced, and if someone who's want to be that super passive investor, then you go into that level. But introduction level, my book is good. Right.
Yeah, no, that's awesome. No, that's awesome. I mean, I like personally, I love getting into that level. I mean, that's what I'm passionate about is helping people, get more educated. Like you said, I think it aligns perfectly. And so not to go into all the weeds, but just a little bit, this idea of risk adjusted return is so important. And it's something that I consistently through the conversations I have gets missed by most people. This idea of if you're just looking at the upside and the potential, right? Or just looking at the return number, and not considering the likelihood of that return, right?
Absolutely.
Right. So tell us a little more about that. What does risk adjusted mean? I mean, elaborate a little for us.
Sure. I love it that you like to go pretty technical, because I think in that terms, and just how deep you want to go, right? So let me explain about risk adjusted return, right? So what is the risk of getting that return, right? So when someone said, I'm going to give you 15% return, but what is the likelihood of that you're getting? Because you and I know that usually when we predict syndication return, we are predicting like 3 to 5 years down the road, right? And if you have $1 million, you probably put all that money, $1 million, in the next 6 months, and you're done, right? So for the next 5 years, you'll be waiting for that. What is the result of my $1 million? What did I put in, right? So so the concept of risk adjusted return basically able to tell you where is the return in the spectrum of the risk, right? So for example, when you look at operation, there's and also disposition, right? Acquisition, operation, and disposition in a full investment life cycle. So other than acquisition, there's operation, and you have in operation, the biggest indicator is cash on cash, right? And on the back end, the biggest indicator is what is your equity multiple when you sell. You're hoping that you're going to make big money on the back end, but cash on cash is like 8-10%, right? And then people talk about overall return. So a lot of time people say, oh, my IRR is 15%, right? But how do you split this IRR into two segments, where which part of it is cash flow and which part of it is back end? Right? So it's called a deal risk profiling, right? So this is the method that we use to split that into two risk side, into two different part of it, right? And when we talk about cash flow, the Wall Street and everyone who knows about investing, lower risk, you're willing to pay higher, right? You're able to you want to pay higher amount of money because the risk is lower. Whereas higher risk, you want to pay lower amount of money, right? So it means cash flow is always predictable because it's happening like in 1 year down the road. So you know the risk of getting that cash flow is low. Sorry, the risk of getting the cash flow is high, right? So sorry, let me clarify that. So to get a certain cash and cash, let's say someone said, I'm going to give you a 10% cash. The risk of you achieving that is pretty low because that's happening like next 1 year and that's operation. Whereas the risk of you getting an exit equity multiple 5 years down the road is high because it's 5 years down the road. Nobody knows what's going to happen.
Right.
Right. So the risk of the back end is always high, whereas the risk on cash flow is always low. Right. So what we do in this risk profiling of a deal is we split into this cash flow and backend, and we say that, oh, this is 70% cash flow, this is 20%, 25% or 30% backend. So it's good deal because now it's more predictable.
So you're saying that deal being that if you're getting, let's say your total return on the deal is $50,000, and what you're saying is, let's just for easier numbers. So 40,000 of that total return is going to come out of the cash flow in the deal, right?
Yep.
You're saying that is a lower risk deal because the predictability of that cash flow, it's just it's easier to predict. It's more likely that cash flow will come than on the alternative. The other amount, I think I only had 10,000 left, but the other amount that was going to come from the appreciation in the deal, it's a farther time horizon. As time goes out, there just increases uncertainty, and it's really hard to predict what you're actually going to be able to sell the property for in 5 years, right? Much harder than to predict the cash flow, because likely in the deals, at least the deals that you and I are buying, from what I understand, I mean, many of these properties have been in business 20, 30, 40 years, right? So that's kind of how I think about it, is like, these have been operating businesses for decades that have been making cash. We're just going to help them make a little more money, right? So the cash flow is there. There's a history of it. And so what you're saying is that it's the lower risk profile because it's more, not guaranteed, but more a higher probability.
Higher probability, yeah, which means you're okay to pay a bit more money for it.
Right.
Right. And we are looking at absolute numbers, right? So let's say deal A is 15% IRR, deal B is 15% IRR, absolute number, right? But where is the IRR mostly coming from? Is it from the back end or is it from the front end cash flow, right? That's where you have to determine, right? But you can't compare with the 15% IRR deal and a 20% IRR deal. But let's say a 20% IRR deal is a lot more on the back end. That's okay because it's paying you more. Right. But in general, if you're comparing a deal A and deal B, which has almost similar total return, you have to see where is it skewed, because that's going to control your risk and that's going to control your probability, which means you're willing to pay more money for it, or you're willing to invest more on it, or you can match it to your own personal profile as well.
Yeah, well, thank you for taking us down the rabbit hole for a second. That was
it's very interesting.
Yeah, I mean, I think it's an important topic that we don't get to speak on much, and probably a level that is deeper than most people understand as they look and evaluate deals. So the concept of a risk-adjusted return is something you can't dig enough into, I don't think.
Yeah. Well, I mean, if you look at stocks, I mean, there's so many books you can go and get stocks, and there's growth stocks, there's value stocks. So many people write about stocks, but not many people write about investing into real estate, right? I mean, there's a lot of people writing about how to buy real estate.
Yeah.
But 95% of the investors out there do not want to be an active investor, right? They want to be passive.
Right.
So this book was written for that 95% of the real estate people.
Gotcha. No, makes total sense. Something else that you hit on is around just, I guess communicating as a passive investor, approaching sponsors, kind of building that network out. I mean, what are things that passive investors or any investors can do to, I guess, show up in the right way, communicate in the right way, give off an air of an education and just come off in the right way to sponsors or to other investors or, whoever they're communicating with?
Yeah, I think it's just be open about it. If you want, if you're looking for sponsors, just say, hey, I'm looking for active sponsors of deals, and this is the type of deals I'm looking for. Just be open about it, and talk to sponsors, right? So one thing I would caution is basically, do not go. I mean, a lot of sponsors are hardworking people, and that's why, I mean, everybody want to make money. Sponsors want to make money. Passive want to
Hmm.
make money, but keep in mind, sponsors are the one who are running the entire show. Right? I mean, especially operators who are buying deals, sourcing deal. That's a lot of work.
Yeah.
Operating a deal and trying to turn around. That's a lot of work, and you want to have certain trust in them, in their capabilities. Right? That's why they're active and you are passive, right? I mean,
Yeah.
and I always put this analogy. The passive investors are the passengers in the flight, whereas the active investors are the pilot, right? I mean, you don't want to go and ask pilot, hey, do you know how to fly this plane? Do you know what happened next, right? I mean, do you know where's the engine? I mean, they are trained to do that, right? Whereas, so there is certain trust that passive investors need to put on the active investors, right?
So
And
how do you
that's
build
important.
that trust? Yeah, how do you build that trust? Say you're trying to develop a new relationship, or let's say an investor is building a new relationship with you, right? You meet a new
Hmm.
investor.
Hmm.
Um, you know, what can they do to start to gain trust in that sponsor?
Just I mean, of course, build relationship, get on the phone and get to know them and all that, right? But at the same time, follow them, what they're doing and what kind of content they're putting out. I mean, look for sponsors who are putting a lot of free content, adding value to people, rather than some sponsor which you do not know where they come from, right? What kind of knowledge do they have,
Mm-hmm.
right? So and you just build, just say, if they send a mail out, if they send a newsletter out, say thank you for the newsletter. It's a lot more back and forth responses can be done with the sponsors, rather than waiting for a deal, right? I mean, everybody wants a deal, a really good deal they want to invest, but just build
Yeah.
that relationship, right? And that's something I see in my investor base, right? Whenever we put up a deal, it gets oversubscribed, and a lot of times the people we put on the deal is people we already know, right? Because I can imagine them and imagine my conversation with them. We know their investment goal, they understand me, rather than taking somebody completely new which we do not know, because the 5 year 3 to 5 year of marriage, right? Right.
Right.
Yeah, and you do not want to get someone which is not a good fit with your personality. So
Sure.
just build that relationship with them, just keep communicating this emails and tags, and I say thank you,
Yeah.
just build that relationship.
And what about from the actual passive investor side? Are there things that investors should be doing to vet their sponsors before they invest
Oh,
in a deal?
that's a big topic, right? So, but I would say, let me summarize to one. The best way to vet a
Yeah.
sponsor is, especially the sponsor who is new, is like talk to the current passive investors,
Mm-hmm.
right? Build a relationship with, hey, how is that person doing? Are they communicating? Because investments it goes up and down, right? Especially in real estate, right? I mean, any investment goes up and down, right? But a lot of it's private, right? The best way to get to know on how investors and how an active investor is performing, or going to be communicating, is just to talk to their current passive investors.
Gotcha. So don't waste the time speaking with the sponsor. I mean, because the sponsor is going to tell you all the good stuff,
Yeah,
right?
of
But
course. I mean, yeah,
speak to the other people that are actually investing with them.
correct.
Yeah,
Yeah, I mean,
that's a
you have to
great tip.
you have to do some homework, right? I mean, you are investing
Yeah.
50 to 100,000, and sometimes people expect everything to be given to them on a phone call, right? You have to go to meetups, you have to go to conferences, you have to be in Facebook groups.
Yeah.
Just talk to people who have invested with us. Just say, hey, how's that person? I mean, sometimes it's pretty easy to identify a good operator and
Mm-hmm.
authentic people, but sometimes you want to you see this deal is really good, but I do not know the guy. Try to see whether you can connect with some of the previous investors or not.
Yeah, no, great tip. So let's switch gears a little bit because I want to hear more
Mhm.
about your business. You've obviously, um, you've grown to over 2,000 doors. You've got a vertically integrated business, and you've obviously grown, fairly quickly. Relatively speaking, right? You said it's been what, about 6 years, 6 or 7 years? Oh, I lost your.
So sorry, 2016 is when we started. I would say 4 to 5 years is when we started. I mean, we
Gotcha.
bought our first building at the end of 2015 is when we closed. So I
So
would say
what?
2015, 2016.
Okay, great. So, and what is it that's allowed you to scale up your business so much so quickly?
Um, Three things. One is hard work. Second is being persistent. And the third is just to try and we always try to do something different from everybody else, right? Like,
Mm-hmm.
for example, when we started, we source all our deals by going direct to the sellers, right? We're doing the yellow letter marketing and all that, where everybody, going to brokers, right? And
Yeah.
so we try to do different. It's a lot more hard work, but that's
Mm-hmm.
where you get the best deals out there. Um, and also vertically integrated company, right, where we own our own property management, asset management, raised money ourselves as well, and not many people are willing to do the property management side,
Mm-hmm.
right? People say that's that's a very thankless job, right? Which is true,
Yeah.
but you need control to get the maximum return of your investment, right?
Mm-hmm.
And so these are a few things that we do, and we do a lot more other things as well. But few things that we do. Um, Maybe the third one is I put out a lot of free content for people, right? And sometimes
Okay.
people ask me, even my podcast, people say, James, why are you telling them all the secrets? Right? But there's no secret, right? Just hard work is more important. I
Right.
can tell you every
Right.
single secret, but whether the person's willing to do that steps that I'm telling you, that's a
Yeah.
completely different story, right? Not many people will do it, like probably
Yeah.
0.1.
No, I think that's a great perspective. I mean, just like anything else, like,
Mm-hmm.
most things, I guess, are except rocket science are not rocket science, right? You can figure them out. And,
Yeah.
and the thing I found in just my life and career is once you get into something, it's usually not as difficult as you think
Mm-hmm.
it's going to be. I mean, at
Mm-hmm.
least from a complication standpoint, but
Mm-hmm.
what it comes down to, right, is the willingness to work hard and
Absolutely.
put in
Absolutely.
the time. And I think that's really what separates folks, right? So you
Yeah.
say you're giving away all the secrets. Well, it's fine to hear it, but are you actually going to turn around and go do it,
And
right?
do
That's a
it. Yeah.
totally different story.
Absolutely. Yeah, it's true. I'm just, I mean, it's not surprising. It's just that sometimes people ask, what's your secret? Well, I can tell you all the secret, but
Yeah.
how many are you going to do it or not, right?
You show up every day. I mean, you're at a property right now, right?
Yeah, I'm in a property right now. We have a lot of pipe bursts right now due to the Texas storm, and I'm here looking at trying to solve this problem because
Mm-hmm.
and not many sponsors are willing to do that, right? They just want to be asset manager behind a computer and they make calls and try to find out how to solve it, right? But sometimes
Mm-hmm.
when owners are on the side, things get resolved much quicker, right? And end of the day, the residents are going to be much more happier and they're going to be staying longer, right? And that's how you make much better returns, which is equivalent to a much better track record, which is equivalent to much better repeatability of passive investors, right?
Mm-hmm.
So like we have raised like almost $60 million with like probably 300 investors, right? And average investment is like 150, and that's unheard of because our track record is so good and people are willing to put in, and that just comes from things like what I'm doing right now. I'm being at the property, right? I'm an
Yeah.
operator. We are trying to solve the problem so that we can get our residents to be happy.
Yeah, absolutely. And yeah, you mentioned a couple other things I thought were really interesting. One
Mm-hmm.
is
Mm-hmm.
just the idea of vertical integration. And so, in my own business, I mean, we're vertically integrated. We take a lot of pride in that,
Mm-hmm.
and see the benefits there. But I'm curious from your perspective, how does that add value to your deals?
It's just a control and fluctuation of control as well. Like for example, when COVID hit, of course our delinquency went up, but we can also reduce our staff to compensate for that, right? Whereas if it's a
Mm-hmm.
third party, if you have a third party property management which is not vertically integrated, then you got no control. It's whatever they want to say, right?
Mm-hmm.
And we do a lot of difficult deals. We do a lot of deep value add and value add deals, and we just need that control to turn around property very quickly, right?
Mm-hmm.
So vertical integration gives you the control. It may not give you the profit, but it gives you the control, and that ends up to becoming a much better return end of the day.
Gotcha. And then you mentioned some of the markets that you're in. You said
Mm-hmm.
Austin. Did
San
you say
Antonio, Texas.
Austin, San Antonio? Okay. I mean,
Mm-hmm.
those are
Mm-hmm.
those are two hot markets. Those are competitive markets. Yet
Mm-hmm.
you said that you find deals off market. So
Yeah.
it seems like there's a disconnect there, or at least something that you're doing differently, like you said. So can you tell us a
Mm-hmm.
little bit about, first of
Yeah.
all, maybe just what is an off market deal, and
Mm-hmm.
then And then what is it? What is the value of finding off market deals?
Yeah, correct. I'm sure you see, everybody offering deals out there, and everybody says off market deal, but off market can be categorized into probably like three types, right? One is where a broker brings you a deal and tells this deal is an off market, but actually the broker, what he does is he also tell 10 other people, right? This is all
Yeah,
off market, and they create this.
They're always off market.
Yeah, I mean, off market sounds cool, and of course, it's going easy to raise money. Right? You say this deal's off market, right?
Mm-hmm.
But what's the real definition of off market? So brokers do that a lot. They bring a deal. They don't really publish it on market, but they create that cool factor of having like 10 people looking at it, and they create internal competition. They still do some kind of best and final off market, right?
Yeah, I call that like pre-market.
Oh, really? That's a good way.
Like they didn't want to, it's because it's a very real thing that brokers have a short list, right? They have a list of people who they know can deliver and who they build a relationship with. And that's the group that they send it out to right before the full marketing package is done. Because if they can get it done there, you don't have to spend all the time and effort going through the full marketing cycle. So those are the pre-markets.
Yeah, well, that is a different category for me, right? The first category I mentioned is that they're just looking for some guy out there to overpay.
Okay.
Right? And the reason why they didn't bring it on market because they're too shy to bring it on market. This must be like really bad deal.
Oh, those are like the LoopNet deals.
The loop, well, it doesn't even get. I mean, the bad deal which they don't have. Sometimes they don't even have listing on it. They don't have an sign agreement from the seller. They just throw it out there and then sometimes they overpromise to the seller, I'm going to get you like 20% more than what everybody else. Just tell me what is it, give me financials, and then they're going to throw it to market and see is there a newbie who's trying to bite on this bullet or not, right? So
gotcha. Okay,
that's the off market I'm talking about. Yeah, the next level is, of course, that's the better off market, that what you described, where it's a really good deal, but they just do not want to market it because the seller could have said that, hey, I do not want my staff to get spooked. Right, just bring it to 3 or 4 good closers, right? That's a good off-market deal, right? But you have to really see which category does it fall. The last category is where there's a handshake between the seller. I mean, well, maybe there's fourth category. The third category is where a broker brings a deal and tells you this deal is something that you can close because you are the perfect person, because this type of deals, like is there a big foundation issue, is there a big claim, is there a loan penalty issues, right? Or if you have a property in front of this property, right? So that's the third category, because they think that you are the best buyer. They're just going to give you a shot, right? So the first, all the top three is involving broker. The last, the best, and the hardest and the best for newbies to start is where they're able to have a direct handshake with the seller.
Gotcha.
Right, you and seller talking directly, and he gives you a price, and that becomes a true off-market deal.
And so, which one of those categories are the deals that you're doing? Which one do they fall in?
So the last two is where I look for, right? So when I started direct off market to sellers, and we're buying handshaking with the seller, and we're buying a deal, right? Which no brokers involved, nobody knows about it, me and seller. But after the first two deals, everything else is through brokers. Well, let me think. There's one which is a unique case which came through Facebook group, so I'm going to talk about that in a short while.
Wow.
So the most of the deals after the first direct to seller, it comes from the third category, where the seller brings to me directly and says, this is, you can execute this the best kind of thing, right? Because they know we are local operators, we can turn around the property, and we are a good closer as well, good track record. And as I said, there's one odd case where I got it through my Facebook group, and I said, in fact, that is the largest acquisition that we have done. It's almost like $32 million in deal, and it came through my Facebook group, right? So
wow.
Tips for your listeners: join my Facebook group. It's called Multifamily Investors Group.
Sounds like it. There's deals to be done in there.
Absolutely, we just did a $30 million deal through that group, right? And
yeah,
that's a unique one.
That's awesome. But so, just going back to why would you want to do an off-market deal? It sounds like a lot of work.
It's a lot of work, but if you look at your time span versus effort versus results, it's much better than underwriting 20 on-market deal and going through best and final and buying overpaying for the deal. I mean, any deals that you go through best and final, you're fundamentally also overpaid. Correct, right?
Yeah.
Out of 10 people who came for the best and final, you can say I won the deal,
Mm-hmm.
but you're also the highest paying guy, right?
Mm-hmm.
And real estate, the fundamental law of real estate is you always have to buy right, which means you always have to buy at the lower value,
Yep.
right? So
Yeah.
you make money when you buy, when you
That's
sell
right.
is where you take the profit, right? So
Yep.
any deal that most of the deals, I would say 99% of the deal that you go through best and final, especially in the hot market, like where I am in Dallas,
Sure.
Austin, Texas, where there's day one hard money and multiple people coming from trying to buy in the cities. You basically overpaid. So you have to pray so that it goes up from that point because you already overpaid. And now you have to hope that market continue to appreciate, right? And I don't like that. I'm a risk averse guy.
Mm-hmm.
I always look at risk. So I always look for deals which is has lower risk, and that the way to find that deals is off market. So rather than doing 20 on market best and final deal, I rather go and do I rather take my time and the stress level and go and look for off market deals and work with some brokers on a very exclusive certain deal level, or
Mm-hmm.
even going direct to seller, because the time versus effort versus result is much better on the off market side.
Gotcha. Yeah, and you're buying ultimately at a better value, which
Absolutely.
allows you to create a better return for the investor,
Yeah,
right?
and if you look at it, you build that relationship with the brokers, you build that relationship with the seller, right? And most of the time, apartment owners they don't own like one apartment, right? They own multiple, right? They
Yeah.
get to know you personally,
Yeah.
they may be selling you more, right? And it's just a feeling of winning, right? When you feel and you get
Mm-hmm.
a really off-market deal, it feels so good because I bid.
Mm-hmm.
Nobody else knows about the deal, and I feel so good.
Mm-hmm.
Versus like I go and compete and I paid the most and I won. And how do I turn around to my investors say that I underwrote this deal conservatively? You can never say that, right? On a bidding war, right? Because hey, you are the guy who paid the most. How can you say you're conservative? You are the worst conservative guy.
Well, yeah. I mean, I guess relative to the other people,
Yeah,
you've definitely taken the most
aggressive, right? Or
aggressive assumptions, right,
okay,
to
yeah,
be able
exactly.
to return the
Yeah,
be able
yeah.
to
How do you
return
go?
the
How do you go and do
returns.
syndication on your webinar? Can you say that I'm the most aggressive guy? Of course, nobody's going to say that, right?
Yeah.
But
Well,
it's
every deal I've ever seen has conservative
conservative.
underwriting.
Everybody says I'm
I've
conservative,
never
but which is
seen a
not true,
deal
right?
with that starts out and says our underwriting
It's
is really
aggressive.
aggressive and we may not achieve it.
Yeah, yeah,
But
yeah. Yeah, unless you're doing a 1031 money where your goal is completely different, or you're a family
yeah,
office, you're more on the wealth
yeah,
preservation thing,
yeah.
then it's
Yeah, that
different,
was the
right?
only other caveat I was going to say is,
Yeah.
there are examples where the investors just have a different return
Hmm.
profile that they're trying to
Correct. Yeah.
achieve,
Yeah. Yeah.
and maybe able to pay a higher price.
Yeah.
But yeah, for the most part, where you're going, yeah,
Yeah.
especially if you're in those hotter markets and there's 30 people bidding, and yeah, you've got to hope that it continues to
To grow.
appreciate,
Yeah.
right?
Yeah.
Continue to
Yeah.
grow.
It's
Right.
yeah.
Well, awesome, James. Well, I mean, I've appreciated all the info. You obviously,
Yeah.
heck, you wrote the book on it, but you obviously know your stuff
Hmm.
and a great level of detail. I appreciate you
Hmm.
sharing some of your insights with us and
Absolutely.
going deep on some of those topics. The last segment of the show is called Keys to Success, and so I'd love to ask you 4 questions. Promise
Sure.
there's no brain teasers in here,
No
but
worries.
the very first question is, what is the question that every investor should be asking their deal sponsor if they only got one question?
That's a really good question. Just their track record, I guess, right? So, and I say it's very hard to get the track record and direct from the sponsor.
Mm-hmm.
It's better to get from the investors who have invested with them. And it's also hard to ask them directly, can you give me a reference, right? So you just have to network and find someone, have you invested with this person, kind of thing, right? And it's an
Mm-hmm.
investment, right? So, um, yeah,
Yeah,
I
it
mean,
sounds like the answer might be don't ask the sponsor a question, ask
mhm.
their investors a question.
Correct. That'll be the best question you can ask, right? The
Yeah.
most beneficial question. But if you want to talk to sponsor, you can ask them about, hey, what kind of deal do you focus,
Okay.
right?
Where's your
What's
focus? Yeah.
yeah? How are you different from everybody else?
Yeah, I like that one. How are you different? I mean, I
Yeah,
think
yeah,
you talked about what you guys have done to differentiate. There's a clear
hmm
value prop there,
hmm
and yeah, it definitely helps
yeah,
competition.
Because everybody is trying to be an active investor right now, right? People go for boot camp, and the next day they said, "I'm an active investor." People invested in passive deals. Let's say they invest in 0.01% into 500 units, and they claim that 500 units is theirs, right? They go around and tell that we own 5,000 units, but actually, hey, you have not been an active investor. So sometimes it's a bit misleading, right? So
Sure,
you to be careful with that.
Yeah. So the track record is really important, and digging in to understand what were you what was your role, and what were you really involved in. Right?
Yeah. What's your role? Absolutely. So that's
Right.
one thing that I talk in my book. Are you an operator? Because operators are the backbone of the deal. They know the business plan. They're going to execute. They control the whole deal, right? And you want to invest with the operators.
Yeah. To me, that's the fun part.
Yeah, that's the fun, right? I mean, but not many people are willing to do the hard work of being an operator.
Yeah, that's true. That is true. So what are you most proud of in your career?
That I know sometimes I think how I make impact for others, right? I mean, when I started this, I never really thought on how quickly we can grow, but we were so passionate. And the biggest thing is we can make impact in many ways, impact to our residents, impact to our own life, personal life, impact to our own wealth creation. And, we also give back a lot. Our mission has always been to educate orphans and in third world country. And right now we are like 330 orphans being educated on a monthly basis where we sponsor the education. So we are proud of doing all that. Yeah. That's our unit count.
That's awesome. That's your unit count.
Yeah. We don't care about the number of units, right? Because number of units can be nebulous, right? But 330 kids, and then we're going to grow that bigger.
That's great. That's a true impact.
Yeah.
What book should everybody be reading?
At least Think and Grow Rich. And the other book is Magic of Thinking Big.
Okay. Very good. And last but not least, what is your number one key to success?
Do things differently from everybody else.
Do things differently. I like it. Very good. Well, James, thank you so much, man. Appreciate all your time. If folks want to learn more from you, how can they reach you?
Achieve Investment Group is my company. Achieve is achieving a goal. ACHIEVE, achieveinvestmentgroup.com. My email is james@achieveinvestmentgroup.com. And I recently launched a free book plus shipping. Shipping is like $4 something for my book. So you can go to passiveinvestinginrealestate.com to get the book. Passiveinvestinginrealestate.com to get the book for free.
Great. You check the book out and check James out with Achieve Investment Group. Well, thanks again for being on the show. Appreciate all the knowledge you share with us, and have a great rest of the day.
Absolutely. Happy to add value to you and your audience.
Thank you.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.